Welcome to the Deep Dive. We're here to unpack the crucial details from key corporate earnings calls.
And today, we're tackling Rogers Corporation. They held their Q3 2025 call on October 29th, right after the market closed.
Right. So our goal here is to get behind those press release numbers. You want to look at the financials, sure, but also management strategy.
Exactly. And figure out why the market reacted so positively. I mean, the stock jumped, 5.6% the next day? Despite the usual Q4 slowdown warnings, that's telling.
It really is. Okay, so let's start with the big picture for Q3. The main takeaway seems to be execution.
Absolutely. They hit the top end of their own guidance, pretty much across the board on the key metrics. It suggests their plan, the operational plan, is actually working.
So the numbers, revenue first.
Okay, revenue landed at $216.0 million. That was comfortably ahead of what analysts were expecting. Consensus was around $207.5 million.
Nice beat, and sequentially.
Up 6.5% from Q2, and even year over year, it's up a bit, 2.7%. So solid growth there.
Okay, sequential growth is good, but profitability, that's where the real story often is, right? Especially with Rogers lately.
You got it. And they absolutely crushed it on adjusted EPS. That's the non-GAAP number everyone watches.
What was the number?
$90.90. 90 cents. The estimate was closer to $0.70, so a really strong beat there.
Oh, 20 cents is significant. And the GAAP number, just for context.
Yeah, GAAP EPS was lower, $0.48, but interestingly, that was also way up from Q2, mainly because they had fewer big restructuring charges hitting the books this quarter. So cleaner results overall.
Fewer charges.
Yeah.
So past actions are starting to, cycle through. Less noise in the numbers.
Precisely. And underpinning that big adjusted EPS beat was margin improvement. Gross margin was up 190 basis points from Q2.
190 basis points, so almost 2 full percentage points to 33.5%.
Right. And getting revenue and margin expansion like that in the same quarter, that signals the internal stuff, the cost savings, the efficiencies they've been talking about are really taking root.
Okay, so the market clearly focused on that. The 5.6% jump suggests investors are buying into this margin recovery story.
They have to be.
So let's dive deeper. What exactly drove that Q3 performance? Was it just good timing, good markets, or the internal changes pulling the weight?
It's a mix, as usual, but the internal changes definitely seem to be the core driver. Revenue-wise, a big chunk of the sequential increase came from portable electronics.
Seasonal, right? Phones and things ramping up.
Exactly. Double-digit growth there. Pretty typical for Q3. But importantly, industrial markets were also strong. That's the third quarter in a row for growth there, suggesting it's not just consumer electronics carrying things.
That's a good sign for broader health. What about their other key segments? Aerospace, EV.
Aerospace and defense got a lift from commercial aerospace demand picking up, EV. Well, that was pretty much flat sequentially.
Flat, given all the focus on EV as a growth engine.
Yeah, it's interesting. They did mention improved demand for their specific power substrates within EV, which is good for their niche. But the overall segment was flat.
Did they talk about why? Is the market still sluggish, or is it something else?
They basically acknowledged the EV market recovery is still tentative. Lots of customer inventory issues still working through the system, So they're not banking on a huge EV surge near term.
Okay, so they're not relying on EV for the immediate boost, which makes the internal cost story even more critical then.
Absolutely. And that's where you see the real power. Adjusted EBITDA hit $37.2 million. That's a 17.2% margin.
17.2%. And the sequential improvement.
Massive. Up 540 basis points from Q2.
Wow. Okay, how do you get that kind of jump in just 3 months? Higher volume helps, better mix helps.
They definitely helped, yeah. But the big lever was cost reduction, realized savings. They specifically mentioned cutting costs in professional services and, crucially, benefits from the global workforce restructuring they started earlier.
So the painful cuts are actually translating into bottom line results now.
Looks like it. They're running leaner. The interim CEO kept hitting this theme. Execution, grow the top line, yes, but keep costs tight and drive operational excellence.
And they gave some specifics on that operational excellence part, right? More than just buzzwords.
Oh, yeah. Very specific. They talked about reorganizing R&D, commercial teams, operations, aiming for more customer focus, and the result. They claim lead times are down significantly already.
How significant?
As much as 60% in some areas.
60%? That's huge. That's not just keeping customers happy. That's cash flow, right? Mm-hmm. Faster inventory turns, less capital tied up.
Exactly right. Better service, better balance sheet. It's textbook operational improvement. And that ties directly into their big strategic move. the footprint optimization.
Right, this dual track thing they're doing, China and Germany.
Yeah, it's quite the juggling act. On one side, they've officially started production at the new ceramic facility in China.
That's a big bet on Asia, local supply chains.
Correct. Lower cost structure for the region, closer to key customers in electronics and automotive. They stressed it wasn't built on spec. They have customers lined up. The ramp is just about qualification now.
Okay, so that's the investment side. But at the same time,
they're restructuring the older ceramic operations back in Germany. A significant downsizing.
and the target saving from that German restructure alone is pretty big, isn't it?
$13 million. $13 million in annualized COGS savings expected by late 2026.
That's a major saving. But doing both at once, ramping up a new plant, winding down an old one, sounds risky. Did they address that?
They acknowledged it's complex, yeah. People, assets, it's not easy. But they framed it as necessary pain for long-term gain. And the total savings picture is even bigger.
Go on.
All the expense reduction actions combined, including Germany, are targeting an annualized benefit of $32 million in 2026.
32 million. Okay, now I see why the market might be looking past any short-term disruption. That's a structural change to their costs.
That's exactly how the market seems to be viewing it. They're underwriting that $32 million figure, trading short-term complexity for a potentially permanent margin uplift.
Right, which brings us neatly to the Q4 guidance, usually the point where management pulls back on the reins a bit.
And they did. Seasonality is real. Q4 revenue guidance is $190 million to $205 million.
So down sequentially.
Yeah, about 9% down at the midpoint. They flagged weaker portable electronics after the holiday build, plus customers managing year-end inventory. Pretty standard stuff.
But year over year.
Still up slightly. Midpoint implies about 3% growth over Q4 last year, so the underlying trend is still positive.
Okay, revenue makes sense. What about margins for Q4? Because that China ramp, surely that costs something up front.
It does, and they were very clear about it. Gross margin guidance for Q4 is lower sequentially, 30 to 32%.
Down from 33.5% in Q3. Why? Volume and mix, partly, I assume?
Partly, yes, but they specifically called out an 80 basis point headwind, 0.8%, directly related to the initial ramp-up costs and qualification activities for the new China ceramic facility.
80 basis points.
Right.
So they're basically prepaying for that future efficiency, taking the hit now.
That's the narrative. It's an investment cost, not a fundamental weakening of the margin profile. And the market seems to buy it, given the stock reaction. They're looking through that temporary dip towards the $32 million in savings.
That takes confidence. Did management sound confident about hitting those longer-term goals?
Very. Despite the softer Q4 guide, they expressed high confidence about H1 2026. Continued growth, better performance across most segments.
Most segments. Any caveats?
Just the timing on the HEV recovery, that remains the one area where they're still a bit cautious on the exact timing of a full rebound.
Okay. And are they putting their money where their mouth is? Capital allocation, buybacks?
Absolutely. They bought that $10 million in stock in Q3, and they explicitly said they expect Q4 buybacks to exceed Q3 levels.
Really? Even with the China RAM costs?
Yep. They still have $66 million authorized under the current program. Management sees the stock as undervalued, sees this as an opportunistic use of cash, especially if big M&A isn't attractive right now. It's a signal of internal belief.
Okay. Strong Q3 beat, clear cost execution story, quantified savings target, acknowledging temporary investment costs. It really sets the stage for our next segment, doesn't it?
It does indeed. Time for the This Is Not Financial Advices segment, where we explore an outrageous but maybe plausible trade idea based on everything we've just discussed.
And this whole situation just screams operational arbitrage. There's this temporary cost drag, the 80 basis points potentially masking a huge structural improvement underneath.
That's the core idea. You have this temporary quantifiable headwind from the China ramp, but happening at the same time, you have the German restructuring and other actions locking in potentially $32 million in permanent savings. That creates a divergence.
A divergence you could potentially trade. So, all right, let's pitch it. The hedge fund idea.
Okay, here it is. It's a relative value trade. You go long Rogers Corporation. You're betting explicitly on management executing that cost plan, realizing that $32 million run rate saving, which should structurally re-rate their margins higher over the next, say, 18, 24 months.
Long Rogers. Betting on the internal execution. What's the other side of the trade?
You simultaneously short a competitor. Specifically, find a competitor who is maybe heavily reliant on older, higher cost manufacturing in Europe or North America, someone who hasn't made the move to localize supply in Asia for those key markets.
So you're betting Rogers' aggressive restructuring gives them a structural cost advantage over peers who are maybe slower to adapt.
Exactly. The thesis hinges on believing that Q4 margin dip is just a temporary investment. If that's true, then by mid to late 2026, as Germany winds down and China ramps up fully, Rogers should exhibit significantly better margin performance than those less agile competitors.
You're essentially underwriting the $32 million synergy, betting that management pulls it off and the market hasn't fully priced it in yet, maybe distracted by the Q4 noise.
That's the potential opportunity. The gap between perception, maybe focused on Q4 seasonality, and the reality of those structural cost savings hitting the run rate. If they deliver, the valuation should follow.
Fascinating. Okay, let's pull it all together then. Quick recap.
Right. Rogers, Q3. A clean beat. Driven by strong cost control, execution on their restructuring, and some favorable mix.
Market loved it. Rewarded the stock because they seem to believe management's story about the operational overhaul and the future margin benefits.
Yep. And the outlook for the first half of 2026 seems confident, underpinned by that very clear $32 million cost savings roadmap. The Q4 guide looks like a temporary dip due to seasonality and that specific China investment cost.
Now, thinking broader, management always talks about competing. Their products are high value, sure, but cost matters everywhere.
It does, especially in the bigger volume markets where they face more competition. Controlling costs isn't just about margin, it's about having the flexibility to compete on price when needed.
Which leads to maybe a final thought for you, the listener, to chew on. They're locking in potentially $32 million in annual savings by 2026. Will they just let that flow to the bottom line, boosting margins?
Or could they use some of that newfound cost efficiency, that operational muscle, to get more aggressive? Could they start using price tactically in some of those contested markets to actually take market share now that they've cleaned up their own house?
Going from defense cutting costs to offense, using lower cost to win business, that would be the next evolution to watch for.
Definitely something to keep an eye on. Okay, that wraps up our deep dive on the Rogers Corporation call.
Thanks for joining us. And remember, this has all been for informational and educational purposes. It's definitely not financial advice. We'll catch you on the next deep dive.